Hello, everyone, and welcome back to the Financing Freedom channel. Thank you for joining me in our Options 101 series, and today we're going to discuss put options. Buying, selling, why you might be interested in put options, and how you might make money in dealing in these. Put options are my favorite, so I hope you join me in this breakdown of put options. Now, what are put options? Technical definition is that put options give the holder the right to sell an asset at a specified price before the option expires. So, what does this mean? Well, when you buy a put option, you own the right to sell 100 shares of your desired stock at a chosen price within a certain time frame. Now, this chosen price is referred to as the strike price. This is the agreed upon price that you will either buy or sell your shares at. Here, if we look at Fidelity, you can see our strike prices for what would be American Airlines in December. Is 42 days out at the time of this screenshot. And you can see that they're round numbers, 8, 9, 10, 11, $12. This is pretty typical. Strike prices are commonly round numbers when you have more of a longer expiration, usually 45-ish days, give or take a little bit or more. Now, for weekly expirations, you'll often see fractional prices, maybe $11, $11.50, $12, $12.50, etc. If you're trading assets that have larger prices, you may see these in $5 increments. It all just kind of depends on the asset you're trading and the normal prices for that. But they adjust these in accordance with potential price movement and fluctuations. Now, what is the functionality of put options? Well, the put option provides the buyer with the ability to put the shares in someone else's custody, or essentially force them to purchase the stocks at this agreed upon price. So, put options are kind of like insurance in a more simpler way. It's how I like to think of it. Now, why would one buy a put option? Well, if you believe the stock price of American Airlines, which currently is at $13.83, will fall below $13, then you can buy a put option. You're essentially purchasing insurance. And what you're doing here is you're buying the right to sell your shares at a predetermined price. In case maybe the stock crashes, you know that you can sell it at a price that you've chosen. Let's say you buy a put option for a $14 strike price that expires in 43 days. And this would cost $85. And you can see this trading ticket here in Charles Schwab. This put option gives you the right to sell 100 shares of American Airlines at this $14 strike price. Cost comparison here. If you were to buy 100 shares outright, it would cost you $1,383. However, by purchasing this put option for $85, you're only paying 85 cents per share. Now, there's two ways you can kind of do this. You can make money in trading this if you think the price is going to go down, or you can use it to save yourself and use it as insurance again if the stock price falls below $13.15 per share, because this is your strike price minus the cost of the put option that you purchased. Prime example here, if you hold 100 shares of American Airlines, you're ensuring that you can sell those at $14 for only an 85-cent per share investment. If you do not own any shares, you can purchase them at any time prior to expiration and sell them at that $14 price because you locked in that right. So you don't hold any American Airlines and it plummets to $10, but you bought a put option with a strike price of $14. You can buy 100 shares of American Airlines at $10 per share and turn around and sell them to someone for $14 at any time before this option expires. By doing so, you're leveraging the power of options to control your exposure with less upfront investment, increasing the potential return if the stock price moves in the direction you're anticipating. So in this circumstance, moving downwards. Let's jump into Robinhood. I'm a very visual learner, and let's see what it looks like. I think they just have a phenomenal chart here, and it breaks down how you move into profit or loss, I guess technically as well, when you purchase this. American Airlines is $13.78. and you've entered this contract to be able to sell it at $14. This kind of shows you the breakdown of if and how price moves in what direction you'd be looking at for profit and loss. So your strike price is $14. If the price moves down, your break even here would be $13.13. And then as price continues to move lower, now you're starting to make profit and or save yourself if you're purchasing a put option as insurance. However, if the price continues to move up, then you've essentially lost that $85 or 85 cents per share that you've purchased. Let's jump into selling put options, which is my absolute favorite. So we're going to jump into an American Airlines put selling ticket here in Charles Schwab. And this looks just like the put buying ticket, except it's the opposite. This is the other side of that trade. And here you would be getting paid $85 for this. Selling puts is like selling insurance to other market participants. When you're selling a put option, you're selling the right to someone else to sell the stock to you at the price you've chosen within the time frame you've chosen. So say you're comfortable buying 100 shares of American Airlines. If the price is at $14, you sell a $14 put option that expires in 43 days for $85 as shown here. This means you're willing to buy the shares at $14 if the price is below the $14 level. Now, by selling this put option, you receive the $85 in premium, and this premium is yours to keep because you've kind of put your money up to purchase these shares. Again, kind of being the insurance person here, you're buying these shares at $14 if the price is under $14. So that $85 is yours to keep. Now, profit scenarios as they play out, the stock stays above $14, you get to keep the $85 premium, which is a 6% return on the $1,400 you would have spent to buy the shares outright. Now, if the stock drops below $14, you are obligated to buy the shares at that $14 price, regardless of the market price. In doing so, you've effectively reduced your purchase cost by the $85 premium, making your purchase price $13.15. This can be pretty beneficial sometimes. Let's say that American Airlines is $13.95. Well, you're still obligated to pay the $14 price for the shares. However, your purchase price is only $13.15. So if you didn't want the shares, you could immediately sell them, collect that profit, or you have a much cheaper entry into American Airlines. And if you think it's going to go up, now you've lowered your entry price and you can profit more as the price moves in the positive direction. Bonuses here, your capital, though locked up and allocated to fulfilling the option contract that you've entered into, it can sit in your account and earn monthly interest while waiting to be utilized to potentially purchase this stock. One reason I do like Fidelity is they pay roughly 4.5% on your money as it's sitting idly. So you can collect some pretty nice premiums. As shown here, this is a little bit of interest money that I had earned just by having my money in the trading account. Pretty nice just for having it sitting in there while I'm working on making some trades. Selling puts, let's jump into Robinhood here. Again, I really like how they break this down. And this is why selling puts is my favorite, because there's so much green in here. You're making interest on the money while it's just sitting in your account. And with the price moving, you're comfortable buying it at $14. So if the price moves upwards, you've collected that premium, you've made all that money. However, if it moves down, you have so much wiggle room. Your break even here is $13.16. And if the price drops to there, you've built in this cushion. So you may have to purchase the shares at $14, but you've made, or at least decreased your entry point into this, giving yourself a lot of wiggle room and lowering your entry. So there's a lot of upside to selling puts. It's definitely my favorite thing to do, not only because you can double dip by collecting this premium and letting your money sit and collect interest, but you get entry prices that are far superior to the current market price on stocks that you already want to buy. So this is pretty exciting stuff. This is, again, my favorite, and that's why there's just so much upside to selling puts. Now, again, you have to remember that You don't want to sell puts on a stock that you don't want to own. These are companies we want to buy, we feel comfortable buying, and we want in our basket. And so that's why we're entering into these contracts to purchase them at these prices. So in reflection, option selling versus option buying. We touched on this in the call video, but again, it's very important and worth noting. According to the Chicago Board Options Exchange, the CBOE, about 10% of options contracts are exercised. Around 55 to 60% are closed out before expiration, and approximately 30 to 35% expire worthless. What this means is that if you are a seller of options contracts, the odds are in your favor. 10% of them are going to be exercised. The other 90%, maybe closed out before expiration. This could be by buyers or sellers, but 30 to 35% expire worthless. So that gives you a 65 to 70% area of you're selling these and you already have a 30 to 35% advantage on where these options will end or expire. So odds are in your favor, and you're choosing the prices you want to settle these at and the dates you want to settle them at. So all of the power is kind of in your hands here, and it just really sets you up for success. Recapping here, option sellers, statistically, you're going to win more often and generate a more consistent income. However, as we kind of touched on, your profits are often capped. There's a limit to how much you can earn from each trade, and generally you know this going in what that profit margin is going to be for you. As an option buyer, statistically, you will lose more often. However, your potential profits can be substantially larger, and in theory, and in some cases, could be technically unlimited. Which one is right for you? That's up to you. Sometimes both are right. Sometimes selling is the way to go. Sometimes buying makes more sense. All of these just depend on your situation and your needs in the market. But touching on it, selling options is certainly my favorite. It's the most lucrative and consistent, I feel, and it's my bread and butter for sure. Thank you for joining me today in our Options 101 series where we discuss put options, buying, selling, and which one might be right for you. Please join us in our next video where we will dive a little bit further into our Options 101 series and touch on the Greeks. All of these funky letters, delta, gamma, theta, vega, what do these even mean? All of this Greek terminology we'll break down, make it make sense, and why it's relevant to options trading. So join us in that video next week. Thank you for watching. Please like and subscribe.